Hey friends, it's Josh from Trade Profile. Going to go over a couple charts this morning as we're set to significantly gap lower during the summer in an election year, and want to talk about what that means with Fed cuts happening and what are we seeing in the auction. Because at the end of the day, the only fundamental that I trust, and I think that you should trust, is human behavior. So the question is how are other participants going to react to what's happening and unfolding in the markets, and how do we get here, and what is likely to happen going forward? So we're going to start by looking at this chart. So what this is these are monthly profiles of the SPY. So if you trade futures, the ES, it tracks with the SPY, which is the underlying ETF that tracks the S&P 500. And currently, we're set to open somewhere around here, around the 512 to 513 per share. That's a pretty significant haircut. Now, noticing where we are, if we look at these profiles, so this is volume on this side, this is time. Okay, so most traded price of July, July, June, May, April, right? So we had a significant move that occurred after June OPEX. So one of the behavioral mechanisms that happens each year are 4 times a year we get these significant options expiration events. The last one was in June, paired with an FOMC. The next one's coming up in September. And so we have these that we go through from window to window. And so we've been moving higher after we had spent a couple months really in the same ranges. And if I look at the idea, the prospect of the SPY opening back here, the way that I think about that, interpret that, is one of the fundamental principles of auction theory, or how we approach markets as behaviorists, is that price moves first. Okay, but if value, so value is the accumulation of inventory. If that inventory can't follow price, then price returns to value. So if we are to go back and look, actually, we'll look inside of this and just look at where we are set to open, you'll notice, and this is looking at a 2-year profile. So this is inventory for the last 2 years. This is actually the year-to-date volume-weighted average price that we're going to open right around. And note this node here. So that's inventory. That's participants who found value around that 515 area. So unable, as we were going higher, we were getting fewer and fewer participants. So unable to sustain up there, now we're coming back to this value. Now the question is, do we stay here and can we continue to build value, or do we test into an area that we didn't do a whole lot of business in, kind of right around the 480 area, or did we really get going and move all the way back down toward 420? I think the 420 scenario is the least likely. For a couple reasons, but we're gonna look at those as we go along. What has been driving a lot of the movement this year has been the AI trade. So NVIDIA, Taiwan Semiconductors, but semiconductors as a sector have been driving and masking what otherwise for the year has been pretty muted. I mean, if you look at the rest of the sectors, there really hasn't been significant movement here. Some of them have been negative, some like discretionary spending. Some of them have been mildly positive, but semiconductors have been really big. I mean, in fact, we're most of the gains. That's now moving lower. Here's the other problem with that, is that they're some of the highest weighted companies in the index. That means that even if we see rotation out of semiconductors into other things, if semiconductors like the NVIDIAs, the AMDs, and all of the related companies continue to contract, that contraction will outweigh any gain in any other sector. So if you see people going into other sectors, which they may do that, that's not really going to help the overall index. Okay, so the index is going to continue to move lower. And in terms of what my roadmap was for this year, given that it's an election year, and we don't have a whole lot of sample size, but over the last 20 general election cycles, when we have come into the election on highs leading into the election, you'll see a contraction. Now, there's a lot of behavioral reasons for this. Why? We get a change in regime potentially, and there's uncertainty. When there's uncertainty, prudent investors reduce their risk. Okay, we're opening here at 510. So when that happens, markets contract. as they're going to do. So this was actually my roadmap for this year. You can see now we're back below the expected high of the year. I am looking for us to go towards this 588, 590 area into the election. Now you'll notice that we still have kind of a bump here in September. We're looking at another FOMC that's coming up, and structurally what drove this breaking here was a bad jobs report after an FOMC. Why is that important? Because one of the things that the Fed has been trying to do in fighting inflation has been to essentially slow the economy down. They really are trying to slow that. Slowing the economy down is the way that we fix inflation. Okay, we don't want to do it too fast, but we don't want to do it too slow either. If we do it too slow, then there's sovereign debt issues that are really nasty that not a lot of people talk about, that are the really thing that people want to get away from. So they're trying to do that in a as easy a way that they can do that. Seeing the jobs number significantly contract was the first mark of, okay, yeah, now this is finally working. Pairing that with the potential for a rate cut. Now, the Fed does not like to cut rates when you're at all-time highs. So we needed lower prices to increase the probability that we're going to get a rate cut. So if you look out at the CME tool and they say, oh, we're going to do, a rate cut in September, that basically the market's saying, yeah, we believe we're going to go lower to justify the rate cut. How fast we go lower could dictate whether we do 25 basis points or 50 basis points. Okay, so either way, I think the cut gives a quick little pop higher before we continue to rotate lower. Now, if we go down here, it could just be taking us up into this inventory and then back again before we move lower. Now, how do I know when we're done going lower? Okay, that's where we look at the VIX curve. Okay, so the VIX curve is looking at volatility and specifically how participants are pricing risk across all durations and expirations. Okay. And what we saw significantly over the last couple of weeks that I think is meaningful is one has been a pinch in all of the expirations such that traders are paying more for risk for the next day than they are a year in advance. So that's what we call a VIX curve inversion. And when that curve is inverted across all time frames, and you can see all of this pinching above that, when that's there, we're at max fear. And then you pair that with the fact that the TDEX, so the TDEX measures, are we looking at risk outside of what's just at the money? So typically hedgers and prudent investors don't look to hedge outside of what's at the money. Why? Because the probability of getting to those strike prices is less. So when you see a TDEX spiking, that means that it's too expensive at the money. Now we're going to go away from the money and look at options that are out there. This is the beginning of what can help slow us down. But here's the warning. As long as we're inverted like this, as long as we see this thing pinched, any price lower is possible. When we had a similar scenario happen in COVID, we were inverted for a month. Okay. Now, when we reverted, that was the bottom. Coincidentally, that also tends to pair with options expiration cycles. Okay. So we've got another monthly expiration coming up here in a couple weeks, and then we'll have another quarterly expiration, one of those big quarterly expirations that happens in the middle of September. So it could be in a couple weeks, it could be in September. Until then, be looking for this regime of volatility to be in play. There's nothing to take it off the table, and it will be categorically different than what we've experienced for much of this year and even last year, where we'd see dips being bought. Here, there's going to be little rallies, but they're going to be sold. Okay, so be mindful of that. The ranges are also expanding, so watch your risk as you're doing that. And then look at structure and inventory as the places where there's likely to be some type of move. When I look at these larger composite levels in terms of whether they're holding, typically it's not like come into it and bounce right off. It's pushing through and get back above. Okay, so those are the types of behaviors. Like if we were to go all the way back down here to 476, which is another node, can I go down below that and back above that? That would be something to defend. If that pairs with a reversion in the curve, that would be significant and a good place to get in and have good risk to defend towards, the next move higher. Overall, the Fed is going to do what they can to keep this thing moving higher. Now, 15 to 20%, no sweat. Because they've raised rates, they've got the firepower to be able to address that quickly and hopefully keep us out of a prolonged recession. So I hope that gives you some insight and some help. I've been out for about a month, just enjoying some summer, and excited to see some significant movement happening as we're coming into this election cycle. We thought that the fall would be pretty significant, and looks like it's going to be that way. So mind your risk, keep working on your playbook. And a playbook trade, so with all of these situations as opposed to any others, a playbook idea is one where you know where the target is first. So if you're expressing risk, you have identified a target. And if you don't know how to identify targets or probable destinations, that's always your first work. After that, it's how do I measure my risk against that? And then once I'm in that, how should it go and how should it not go? So that I'm priming the pump of my brain to take the appropriate action if needed to preserve capital and be ready for the next opportunity. Have a great week. I hope that is helpful. I'd love to hear your feedback and thoughts on this, and if insight like this is helpful for you as you're trying to navigate markets. And we'll talk to you soon. Okay, peace.